Hi guys, my name is Sarvan Kumar. Welcome to Rathod's IAS. Guys, in this class we are going to discuss about the Economic Survey 2021 and 2022, which is placed in Parliament by our Finance Minister Nirmala Sitharaman. Guys, before we discuss about the data that we actually see in the Economic Survey of 2021 and 2022, before that we should have a good conceptual clarity with respect to different macroeconomic concepts that the Economic Survey mentions. Without having a conceptual clarity of different macroeconomic concepts, you can't appreciate the data that you actually try to study in the Economic Survey. So, because of that, we first decided that you should have a good conceptual clarity with respect to all these topics, and then we will discuss about the data. So, we will discuss the Economic Survey in two parts, and in this first part, we are going to discuss all those macroeconomic concepts mentioned in the Economic Survey, and in the next part, we are going to analyze that data so that you can interrelate the concepts as well as the data in two separate videos, right? So, what are these macroeconomic concepts that are mentioned in the Economic Survey? So, one by one, we are going to discuss each and everything, and we are going to have a good clarity at the end of the video with respect to each and every topic. See, we all know that Economic Survey is an annual statement with respect to the performance of the Indian economy for the past 12 months. And it is placed in the Parliament just before one day before the budget is placed in the Parliament. Now, we are going to discuss about all these important facts with respect to the Economic Survey in the next video, but in this video we are going to mainly confine ourselves in developing the conceptual clarity with respect to various macroeconomic concepts, without which you can't understand and appreciate the data in that survey. So let's begin our video, and in the first topic what we are going to discuss is all about the GDP growth, the GDP at current prices and GDP at constant prices. Guys, I know that many of the UPSC aspirants who are listening to this class may comes from different streams, different disciplines, right? So, at times, to understand the concepts of economy becomes very difficult for the students. So, what I have decided is, first we are going to have a conceptual clarity with respect to all these topics with some examples. Remember, if you understand an example in economy, it gives a lot of conceptual clarity. So that's the reason why all those topics which we are going to discuss right now is going to have some examples which makes the things very clear for you, right? Now we will understand what this GDP is all about. Guys, we all know that GDP stands for Gross Domestic Product. Gross Domestic Product, right? Now, with a basic example, first we will understand what this gross domestic product is all about, right? Now, take the example of a shirt. Remember guys, see, we're going to understand the concept of GDP with the example of a basic shirt, right? Right. Imagine this is a factory. Imagine this is a factory which produces this shirt. Now, he is the owner of that particular factory, and he is saying that the price of that shirt in the manufacturing company is 80 rupees. I would say the value of the shirt in this manufacturing company is 80 rupees. Right? Now, automatically when this manufacturer says that the value of the shirt at my factory is 80 rupees, then automatically the value of output is equal to 80 rupees, because the shirt is the output of that particular manufacturing company. So as a result of it, when the manufacturer says the value of the shirt at his manufacturing unit is 80 rupees, then of course the shirt is the output of that particular factory. So automatically the value of the output of that particular factory is 80 rupees, right? Now, understand that in order to manufacture that shirt in that particular company, the manufacturer took inputs. He needs inputs, right? In order to manufacture that shirt, he needs input. Say for example, he have purchased cotton and he also needs electricity. He also needs electricity. Now, if we try to assign values to these inputs, say for example, this manufacturer have purchased the cotton at 20 rupees and the electricity was purchased by that particular person at 10 rupees. Right? Now, what is the value of inputs here? So, the value of inputs, both the cotton and electricity, is 30 rupees. What is the value of output here? The value of output is 80 rupees. So, try to understand, the manufacturer took inputs value of 30 rupees and he added some value to it, 50 rupees, and he ultimately made the value of the product, the output, as 80 rupees. Now, how do we define the value added? See, value added is equal to output minus intermediate consumption. Output minus intermediate consumption. So, what is the value of output here? The output is 80. What is the value of intermediate consumption here? The value of intermediate consumption is 30. So, the value added is equal to 50 rupees. This is how the manufacturer took an inputs worth of 30 rupees and added a value of 50 to it and made the value of the product, that is output, as 80 rupees. So far the things are very clear. Now comes the main question, how the manufacturer have added a value of 50 to the inputs that he have taken. This is the main question. Now how the manufacturer added the value of 50 is the basic question. Now let us try to decode it. See, first, now in order to run the factory, he needs to employ some people. He needs to provide employment and he needs workers, right? Now, in order to provide salary to that people, right, in order to run the manufacturing company, in order to run the machinery in that particular factory, he needs to employ the people and he needs to pay salary for them, right? Now, we consider it as compensation to the employees, right? We consider it as compensation to employees. For example, take it as 10 rupees. Consider that for the workers to work to stitch that particular shirt in the manufacturing company needs to get paid by 10 rupees for each and every shirt, right? Next, the important component of the value added is, these are the components of value added, how the value added to that particular inputs by 50 rupees. The next important component of value added is, right, consumption of fixed capital. Consumption of fixed capital. Guys, you have to understand that the building, the machinery which is installed in the factory, see, this is a building, right, and we have a machinery being installed in this particular factory. Remember, these machineries and buildings have an expiry period. To understand it in a layman language, the machinery will have a certain period of time. Only for that particular period of time, the machinery will work continuously. Say for example, this machinery is going to work for 10 years. What does it mean? The machinery can be used by that particular manufacturer in that manufacturing company only for up to 10 years, and after that he needs to replace it, because you know, each and every moving part, a mechanical part, will go wear and tear. Over a period of time they need servicing, and over a period of time they need to get replaced. Imagine the example of a bike. Over a period of time you need to service it, and after a period of time they completely go wear and tear and you need to replace the engines. Similarly, these machines also. Now imagine, for example, if the manufacturer collects 10 rupees on the each sheet, after a period of time he might get 10 lakh rupees. Imagine the prices of the machinery after the 10 years is 10 lakh rupees. So the manufacturer collects 10 rupees on each and every sheet, so that after a period of 10 years he will accumulate that 10 rupees as 10 lakhs, and the 10 lakhs can be utilized to replace this machinery in that particular factory. Remember, the compensation to the employees is provided as a salary for the employees are working people, and the consumption of fixed capital, that is for example 10 rupees, is not going to be a profit in the pockets of the manufacturer, because remember, this amount is not being utilized by the manufacturer as a to get into his pocket, but this amount is utilized by the manufacturer to replace the machinery over a period of time. So it's not a profit for him, right? Next, the third important component is, after all, a manufacturer manufactures the shirt for some profit, right? So when we have two important terms you need to remember here with respect to the profits. See, the first one is operating surplus, and the second one is a mixed income, operating surplus and the mixed income. Now, to put it in a layman language, I would simply say it as a profit, right? Now imagine the profit that manufacturer expects from a particular manufacturing a shirt is 20 rupees, right? Operating surplus and mixed income are similarly going to represent the simple word that is profit. Now, why do we use these two important terms differently is simple. Now, in case of incorporated companies, right, those companies which are registered with the government and can avail the loans and pay back the loans, we call them as incorporated companies. And for those kind of incorporated companies, if at all they add a profit of 20 rupees, we call that profit added by those incorporated companies as operating surplus, right? Incorporated companies. Now, if the same thing, if the same addition was done by unincorporated companies, we call those profits added by that particular companies as a mixed income. Say, take for the example of handloom weavers, where all the people of the family will come together, will provide their labor input in manufacturing of the shirt. Now, if they add a 20 rupees profit to the shirt they manufacture, we call that profit added by them as mixed income. But in case of the registered companies, incorporated companies, we call that profit added by them as operating surplus. I hope the things is very clear for you right now. Next important component is the production taxes. Now, try to understand that in order to run this particular manufacturing company, remember, he needs to purchase a land or he needs to take a land on rent in order to set up that unit there. For that, he needs to pay stamp duties for the government. Now, in order to employ the people, in order to make them work in the factories, he needs to pay a labor fee, a labor regulations fees for the government. Next, in order to run that particular machinery, particular plant, he needs to take a license. In such a way, the particular manufacturer, in order to run that unit itself, he needs to pay different kinds of taxes and levies and duties for the government. We call these taxes as production taxes. But you have to be very careful here. The production taxes are altogether different from the product taxes that we are going to discuss just for a while after now, right? The production taxes are altogether different when compared to the product taxes. So, irrespective of whether the manufacturer produces the goods in the particular unit, the production taxes are levied upon them. Now, what is the meaning of this statement? You are going to understand it just while from now, okay? Now, understand all the production taxes paid by this particular manufacturer for the government, and if we divide it for each and every shirt, try to understand it if it comes as 10 rupees. Now, totally what is the value here? What is 10 rupees? 10 plus 10, 20, 20, 20, 40 and 10 rupees is 50. In such a way, the manufacturer have added a value of 50 rupees. The manufacturer added a value of 50 rupees to that particular shirt. I hope it is very clear for you right now. Now, try to understand. Right. Now, when the shirt, now I hope you understood what is the meaning of this value added and how the value is added by the manufacturer for the 30 rupees of inputs that he have taken. Now, with this 80 rupees, say for example, imagine this shirt was bought to any retail shop. Imagine this shirt was bought to a retail manufacturing unit. Now here, try to understand. Now here, you all know you all know there is a clear difference between a direct tax and an indirect tax. Now, if impact of tax and incidence of tax is on the same point, we call it as a direct tax. What is the meaning of impact of tax? Say for example, this is the government, guys. This is the government and this is the individual. Now, what is the meaning of impact of tax? Impact of tax means on whom the tax is being levied. Incidence of tax means ultimately who pays the tax. Now, impact of tax is on this person and incidence of tax is also on this person. We call such kind of taxes as direct taxes. Now, take another example. Imagine this is the government and here we have a book selling company. Now, he is the consumer. Now, what the government says to the shopkeeper or shop owner is, for every 100 rupees worth of book you sell to your consumers, you need to pay me a tax of 10% on it. Now, what is the 10% of the 100 rupees? Total 110. So, a book manufacturer or book seller needs to pay an 10 rupees amount on each and every 100 rupees worth of book that he sells to his consumers. Now, the impact of tax is on whom the tax is being levied? It is on the shopkeeper. Now, what the shopkeeper is going to do? He will collect even the 10 rupees from us. When we go to the shop, you often find that if you ask the price of the book, they may say you it is 100 rupees. And later what they are going to say, that there is a tax of 10% on the book. Now, 10% of 100 is 10 rupees and the shopkeeper collects 110 rupees from you. Now, who paid the ultimate tax here? You paid the tax to the shopkeeper and the shopkeeper in turn paid this to the ultimate government. So, impact of tax is on the shopkeeper and incidence of tax is on the ultimate consumer. We call such kind of taxes as indirect taxes. So, impact of tax and incidence of tax is on the single point, we call them as direct tax, and if impact of tax and incidence of tax is on the multiple points, we call them as indirect taxes. I hope it is very clear. Now, try to understand, once we had a tax called VAT, right? Value added tax. Once we had a tax called value added tax, right? Now, in this value of 80 rupees, in this output of 80 rupees, what is the value added here? See, input is 30 plus value added is equal to 50 rupees. Ultimately makes the output as 80 rupees. Now, once the shirt was brought to the retailing unit, like the indirect tax, a percentage of VAT is levied on that particular shirt. Now, what is the value added? Say for example, the VAT is 10%. VAT, the name itself suggesting it's a VAT, value added tax, tax levied on the value added. Now, what is the value added here? 50. So, what is the 10% of the 50? 5. So, ultimately, the price of that particular shirt becomes 85 rupees, right? Don't confuse that if the price of the shirt is 80 rupees and the tax upon it is 10%, it is not going to, the shopkeeper is not going to sell that particular shirt at 88 rupees because the tax is value added tax. We need to collect tax only on the value added, that is 50 rupees only. So 10% of the 50 rupees is 5 rupees. So instead of collecting the 88 rupees, the shopkeeper is going to collect 85 rupees from the person. Remember, the way in which the VAT is currently worked in our example, it is the same way in which the goods and services tax is working all over the country. Remember that the GST, goods and services tax, is called as a single VAT for the whole country. A single VAT for the whole country, right? So, in such a way, we have this goods and services tax. Now, try to understand, see, so what is the value added here? Ultimately, the 55 rupees. Ultimately, the value added for that particular shirt. See, we have took an input of worth of 30 rupees and ultimately we added a value of 55 rupees by the time it is being consumed by the consumer. Now, see, so the gross value, we call this 55 rupees as gross value added at market prices. We call this, see, ultimately the value added at market prices. See, when the shirt is sold in the market, there we have imposed a tax of 10% on the value added, GST, right? So, in such a way, ultimately we have added a value of 55 rupees to it. We call such value addition as value added at market prices because it was brought to the market and is sold to ultimate consumer. Now, try to have a formula for it. Now, understand, Imagine, now we have a gross value added at market prices of one shirt at 55 rupees. In such a way, we have a different shirt 1 gross value added at market price for one shirt, and we have the GVA at market prices for shirt 2. And in such a way, if we continue GVA at market prices for shirt 3, in such a way, if we add each and every value added to all the products, and all services produced in a country in one financial year, we have GVA at market prices. Now try to understand the GDP is equal to GVA at market prices. The GDP is equal to GVA at market prices. This is the meaning of GDP. We have added a value of 55 rupees for the one shirt. In such a way, there are shirts, right? We have different kind of products like pens, laptops, like tires, cars, and we have different kinds of services like hair salon services, like educational services, like hospital services. In such a way, each and every person is going to add some value to it, like the way in which in our example the manufacturer have added a value of 55 rupees. Now all such kind of 55 rupees are added in the economy in a financial year. We call it as GVA at market prices. You understood GVA at market prices. Now the whole GVA at market prices for each and every product and service in an economy, in a financial year, is nothing but the GDP. I hope you understood what is the meaning of GDP now, right? Now, so you understood what is the meaning of GDP. Now, what is the meaning of GDP growth rate? See, I try to understand, in a particular year, a car manufacturer company have produced 100 cars. Imagine, in first month, a car manufacturing company have produced 100 cars. In the second month, the same car manufacturing company have produced 110 cars. Now, what do you say? The growth rate of that particular company is 10%. So, the growth rate of that particular company have increased by 10% because, see, 10% of the previous year is 10. So, the 110 shows the number of manufacturings of 110 shows that the car manufacturing company have achieved a growth rate of 10% in a month. Similarly, the GVA at market prices, what we get, remember the GVA at market prices is nothing but the value added, that 55 rupees value added for the shirt. In such a way, if we calculate, if we add all such value added for all products and services in an economy, we call simply it as GDP. And if such kind of a GDP increases to the next year, or for the next year in such a way, we call it as, in a similar way, we call it as GDP at growth rate. GDP growth. Say for example, the GDP of the country is 100 rupees. For example, and in the next year, if it increases to 110 rupees, we say the growth rate in the country is 10%. This is the meaning of GDP growth rate. Next, we have the two important terms called GDP at current prices and GDP at constant prices. So, what is the meaning of GDP at current prices and GDP at constant prices? In order to understand it, so I hope you understood the GDP and GDP growth rate. Now, we try to understand the GDP at current prices and constant prices. So, GDP at current prices and constant prices, simple. Say for example, guys, in order to calculate the GDP at current prices and constant prices, we need a base year and we need a prices of that particular product in the base year, right? Now, understand. Imagine the base year is 2011 and 2012. For example, see, the prices of a pen, the price of a pen in this base year is 10 rupees. The price of the pen in the base year is 10 rupees. Now, understand, in 2021 and 2022, 10 pens have been produced. Now, in 2022 and 2023, right, 20 pens have been produced, right? And see, and the price of the each pen in the current market is 20 rupees. So, the price of the pen is 10 rupees in the year 2011 and 12, and it is the base year, and the price, current prices is 20 rupees. Now, what is the current prices? See, If we multiply the number of goods and services produced in a country with the current prices into 20, we get the GDP at current prices. If we multiply the number of goods and services produced in an economy with the base year prices, we get the GDP at constant prices. We call the GDP at constant prices as a real income, real national income, and we call the GDP at current prices as a nominal income. See, often you heard in your current affairs that by 2024 and 2025, India thrives to become a 5 trillion economy, right? This 5 trillion economy is nothing but 5 trillion worth of the national income in the form of GDP. Now this 5 trillion is nothing but the total number of goods and services produced in the country during that period multiplied by the prices, current prices, right? Say for example, if we produce 10 goods and the price of the each good is 10 or for example 20, we get 200. Now in such a way the 200 should be equal to 5 trillion. This is the meaning of achieving a 5 trillion economy by 2024 and 2025, right? I hope you understood. This is the meaning of GDP at current prices and GDP at constant prices. Remember, GDP at current prices is nothing but if we multiply the total number of goods and services produced in the economy with the current prices itself, we will get the GDP at current prices. If we multiply the total number of goods and services produced in the economy with the base year's prices, we get the GDP at constant prices. And the GDP at current prices is called the nominal income, and the GDP at current prices is called nominal income, and GDP at with base price is the GDP at constant prices is called real income, right? I hope you understood it. So these are the basic important terms you need to understand before you go and look into the economic survey, right? Even for those who already have a good idea about all these concepts, it would clear the concepts very, right? If at all you have any doubts and gaps in between. I hope you understood what is the meaning of this GDP and GDP growth rate, GDP at current prices and GDP at constant prices. Next, we will try to look at the rest of the important terms that we usually come across in the economic survey. Next we have the term inflation, right? Now, whenever you heard the term inflation, just try to concentrate. Inflation is nothing but the general rise in the prices of goods and services over a period of time. Now, what does it mean? Say for example, imagine here is a coffee. Now, in the year 2000, the price of this coffee is 10 rupees. Now, imagine now in the 2022, the price of this coffee is 20 rupees. Now, this is the meaning of the general rise in the prices of goods and services over a period of time is termed as inflation. The concept didn't end there. We can't say, see, for suppose somebody asks you what is the inflation of the coffee from 2000 to 2022. We simply can't say the inflation is 10 rupees. Inflation is not expressed in monetary terms, guys. Remember, inflation is not expressed in the monetary terms. Inflation is expressed as a percentage change. Inflation is expressed as a percentage change in the price index. Inflation is expressed as a percentage change in the price index. Now, with a small example, you can clearly understand what is this inflation and what is this price index is all about, right? Let us try to have an example. As I said in the beginning of the class itself, the economic concepts, the clarity with respect to the economic concepts can only be achieved over a period of time by listening to number of examples, right? Now, try to understand. We will try to understand first how do we construct the price index, and then how do we, by using the price index, we calculate the inflation rate, right? Now, try to take the example of rice. Now, the price of the rice is 20 rupees per kg in the base year 2011 and 2012. Next, the price of the rice have increased to 30 rupees per kg in the year 2012 and 2013. Now the price of the rice have increased to 40 rupees per kg in the year 2014 and 2015. Now let us try to calculate how this price index is calculated and how the inflation is also calculated. Now let us try to calculate the price index. The price index for the year 2012 and 2013, the formula is, the price index is calculated as the prices of a particular product of the current year, that is 30 rupees, the prices of the same product of the base year or the previous year 20 multiplied by 100. What do we get here? What number will we get here? See. So 150. So the price index of the year 2012 and 2013 is, the price index of the year 2012 and 2013 is 150, right? Now similarly the price index for the year 2014 and 2015 is, see, similarly we will calculate the price index of the previous year. See, in the 2014 we have the prices of the rice as 40 rupees per kg, and the base year prices is, the previous year prices is, see, the base year prices is 20. So in such a way, what do we get here? If we multiply it, we get the 200. So you need to remember the price index of the year 2012 and 13 is 150. The price index of 2014 and 15 is 200. Now by using these price indexes alone, we are going to calculate the inflation rate. How do we calculate it? Simply the inflation is calculated as, see, the price index of the current year, that is 2014 and 15, minus the price index of the previous year, that is 2012 and 13, 150, divided by the price index of the previous year, that is 150 into 100. So what do we get here? 50 by 150 into 100. So 1 by 3. So 100 by 3. 100 by 3. So approximately, now we say we get the number as 33.3%. So inflation rate of rice in the year 2014 and 15 is 33.3% when compared to the year 2012 and 2013. This is how you calculate the price index, and this is how you calculate the inflation rate. I hope it is very clear for you right now. Now what is the wholesale price index? I hope you clearly understood what is the price index and what is the consumer price index. These are the two important terms you need to understand. So if we take the prices of each and every product, and if we calculate the price index of each and every product for all the goods that are traded in the wholesale market in a similar way that we have calculated, we will get the wholesale price index. Now next, what is this consumer price index? So consumer price index is nothing but if we take a certain basket of goods and services, say for example food, beverages, cloth, education, in such a way, if we take only the prices of certain particular goods, and if we calculate the price indexes like the same way here we have calculated, and if we express the inflation, as same way as 33.3%, we call such inflation as the consumer price index based inflation. Currently the inflation targeting is the work of the RBI, Reserve Bank of India, and it is currently considered as a measure to control inflation in the country. So the ultimate measure is the CPI combined. In order to have a further clarity with respect to all these different kinds of macroeconomic concepts, so you have the courses available in the Rathod's website. Please do visit it and try to have a good conceptual clarity, because guys, always try to follow the trend. UPSC these days are asking the questions like the way in which they once asked. These things, these kind of trends always mandates an UPSC aspirant to have a good conceptual clarity. Recently in the UPSC exams, you have seen the questions asked directly from the facts, but now they need you to have a good conceptual clarity. So all these So having a clarity with respect to all these concepts is very much important. So that's the reason why we also have divided the economic survey classes into two parts, where in the first part we are clearly explaining you the macroeconomic concepts, because conceptual clarity, application of the knowledge is very much needed for the UPSC prelims particularly, right? So this is about the inflation. I hope you understood the meaning of inflation right now. Next we have this important term called capital to risk weighted asset ratio, right? Guys, what is the meaning of asset? What is the meaning of asset? Asset is something which earns some revenue for you, Take the example of a building. Imagine if you construct a building, and if you give that particular building on rent, you will earn some money. Now imagine you have purchased a car and you have given this car on rentals. You will get some income, rental income. In such a way, whatever the things that earns you some income and profit, we usually consider them as asset. If you construct a building, give it on rent, it will give you some income. The building is considered as asset. You purchase a car, give it on rent, and that particular car is going to give you some rental income. We consider that particular car an asset. But you have to remember, if you construct a building and you yourself live in that particular building, it is not going to give you any amount of income. So then you don't consider that particular building as an asset. If it earning some amount for you, then only we consider an asset. I think it is clear. The meaning of asset is clear. Now, what is considered as an asset for the banks? What is considered as an asset for the banks? See, if the banks extends loan to its consumers or customers, then what happens? The banks is going to get some loans paid by that ultimate consumer, right? Say for example, if the bank gives a loan of 1000 rupees for a particular person, if the bank says interest rate is 10% per annum, then automatically the person is going to pay 100 rupees for that particular bank annually. So this 100 rupees income is nothing but the profit for the banks, the income for the banks. So whatever that earns some income for us, some amount of money for us, we consider them as an asset. So the loan is considered as an asset for the particular banks, right? Now I hope you understood the meaning of assets here. Then what is the meaning of capital to risk weighted asset ratio? Now let us try to understand the concept as usual by an example. Now, as you understood the meaning of assets, now we are going to understand the meaning of risk weighted assets, right? Say for example, here we have two important fellows, right? Imagine this guy is a stockbroker. Imagine this guy is a government employee. Now both these persons want a loan of 1000 rupees. Both these persons wants a loan of 1000 rupees from the banks, right? From a bank. Now we'll try to understand what is this assets and what is the risk weighted assets. Now try to observe who have a less chance to repay the loan that is taken from the bank. Of course, the stockbroker. Why? Because the stockbrokers often invest the loan amount in the stocks. You all know that the stocks are subjected to the market risks. So nobody can guarantee that the stockbroker is going to earn some profits for him. So as a result of it, if the stockbroker have a lot of risk to repay that loan for the bank. But on the other hand, the government employee have a less risk because he will get a fixed amount. As a salary. So as a result of it, this government employee have a lot of chances and less risk to repay that loan for the bank. So according to the level of risk a particular person has with respect to repaying that loan amount for the bank, the RBI in its monetary policy assigns risk as a percentage for different kinds of assets. Say for example, these two persons got loan from a particular bank. Say for example, this is the bank, and from this bank, this particular persons have got the loan. Both got the 1000 rupees. Now what I said to you, RBI is going to assign some weight, right? RBI is going to assign some risk, I would say. The RBI will assign some risk to the assets that they have given to different kinds of persons. Now, so what is the value of assets now? 1000 rupees. both the persons took the assets of 1000 rupees. Assets means assets are nothing but loans for the banks. Try to put this thing in your mind. Next. Now, what is a risk-weighted asset? As I said, the RBI is going to assign a risk for any particular asset. Imagine the RBI have assigned a risk of about 150% for the loan given for the stockbroker, and RBI have assigned a risk of about 100% for the loan given for the government employee. You can clearly observe that as the chances are very less when compared to the government employee for the stockbroker to repay that loan, the RBI have assigned a more risk for the loan given to him. Now, what is 150% of the 1000? Of course, it is 1500 rupees. And what is 100% of the 1000? It is 1000 rupees. So, cumulatively, what do we got here? 2500. So, the assets is 2000 of that particular bank. Because the bank have given the loan. Loan is considered an asset. So, the normal assets of the bank is 2000 rupees, but the risk-weighted assets of the bank is 2500 rupees. 2500 rupees. I hope you clearly understood what is this risk-weighted assets. Now, let us try to understand what is this capital to risk-weighted asset ratio. Now, capital to risk-weighted asset ratio simply means the banks will have a certain amount of the capital while they are establishing. I hope everybody knows the meaning of capital after all these days of preparation, right? Now, what is the meaning of capital to risk weighted asset ratio? Say for example, what is the risk? It is a ratio measure, right? It's a capital measure, right? Simply, say for example, we have a risk weighted assets of 2500. Risk weighted array assets of 2500. Now, the capital to risk weighted asset ratio is also known as the capital adequacy ratio, which mainly got its origin from the Basel III norms. Currently, the Basel III norms are not being implemented in the country due to the COVID-19 pandemic. The government decided that they would be implemented in the country after 2023 January. Right? As of now, we don't have it. But who stipulates this capital to risk weighted asset ratio currently in the country? It is nothing but money market regulator, that is RBI. RBI is going to stipulate that all the banks, all the scheduled commercial banks need to maintain a certain level of, certain percentage of capital as a part of their risk weighted assets. Say for example, if RBI says that all banks should maintain 8% of the capital as a risk weighted assets. As percentage of the capital as risk-weighted assets, right? Now, try to understand. If the bank have a capital of 100 rupees, now they have a risk-weighted assets of 2500 rupees. So, what is 100 rupees of 2500? See, so say for example, if RBI says it should be 8%, or say for example, if RBI says it has a 10%. Now, what is the 10% of the 2500? 250. But what is the capital that the bank have? Only 100. Only 100. Now the bank needs to increase it to 250 by adding 150 rupees of additional capital. 150 rupees of additional capital. Right? Now, try to understand now what is, see, imagine if a bank have a capital of 250 rupees. A bank have a capital of 250 rupees. 250. Now what is the risk weighted assets of it? It is 2500. What is 250 of 2500? What is the percentage of 250 out of 2500? It is just 10%. Now imagine if RBI says that capital to risk weighted asset ratio should be 8%. So already bank have a capital to risk weighted asset ratios of 10%. Now it's not a problem for the bank. Remember, capital to risk weighted asset ratio is a measure of the capital. Here the capital is 250 and the risk weighted assets is 2500. If RBI says the capital to risk weighted assets need to be maintained by 10%, so 10% of this 2500 is 250 of course. Next, so as a result of it, imagine this particular bank has a capital of 250 and have a risk weighted assets of 2500. Now understand, this bank is maintaining more than the RBI stipulated capital to risk weighted ratio of 8%. Now imagine this bank, another bank which has a capital of 150. Now their risk weighted asset is 2500. Now they needs to increase the capital by 100 rupees. Take another example, right? Take the another example. If a bank have a capital of 100 rupees and the risk weighted assets is 2500, they need to increase the capital by 150. In such a way, the capital to risk weighted asset ratios is a capital measure. capital measure. So every bank will extend different kinds of loans, different loans to different kinds of persons. RBI is going to assign a weightage, different weightages for these different kinds of loans given by that particular banks. So as a result, so on the risk weighted assets in such a way, the banks need to maintain a certain percentage of capital. This is called capital to risk weighted asset ratio. Currently the capital to risk weighted asset ratio is being stipulated by the RBI for the banks. I hope you clearly understood the capital to risk weighted asset ratio. Now for example, if the risk weighted assets is 1000 and if RBI says the capital to risk weighted asset ratio needs to be maintained by 8%, then banks should maintain at least 80 rupees as a capital, right? 80 rupees as capital, because see what is the 8% of the 1000? Of course 80, right? So in such a way, the banks need to maintain a capital to risk weighted asset ratio as stipulated by RBI a period of time. Imagine the capital of a particular bank, imagine the risk weighted assets of a particular bank is 1000. Now if RBI says then the banks should maintain the capital to risk weighted asset ratio of 10%, then what is the 10% of this 1000 rupees? 100. So bank should maintain a capital of 100 because the capital 100 is just 10% of the risk weighted assets. Every bank will have a risk weighted assets, certain percentage of the risk weighted assets. If at all RBI says 10%, the bank need to maintain 10 rupees. If the RBI says 8%, the bank need to maintain 80. This is the meaning of capital to risk weighted asset ratio. I hope it is very clear for you right now, right? Next we are going to discuss about the non-performing assets. Just now we have discussed about the meaning of asset, right? Asset is something which earns some profit for the entity. Now in case of banks, what is the asset? In case of bank, assets is nothing but the loans. And in case of banks, what is the liabilities? Liabilities is nothing but the savings amount. Liabilities is nothing but the savings amounts that we usually deposit in our savings banks accounts, right? See, if we save our amount in the savings bank account or the current bank account, over a period of time, when we demand it, the bank need to pay to us. So it is considered as a liability. Say for example, if I need to pay you 100 rupees, what I would say, I owe you 100 rupees, or I would say I am liable to pay 100 rupees for you. Similarly, so as a result of it, all the savings amounts, both in the savings account deposits, current account deposits, all that money that we save in these accounts are liabilities for the banks. On the other hand, the loans that they extend will generate them some income in the name of interest rate. So as a result of it, the loans are considered as assets for the banks. Now imagine this is a bank. And this bank have given to this person a loan of 1000 rupees and the interest rate is 10%. Now you have to understand two important points here. One is performing asset, one is a performing asset, the other one is a non-performing asset. Performing asset or standard asset. Performing asset or standard asset. What is the meaning of a performing asset or a standard asset? Imagine, see, what do we say? See, for example, this person took a loan of 1000 rupees and 10% is the interest rate per month. Let us consider a hypothetical situation. Now, if the person who took the loan and the maturity period is 1 year, that is, what is the meaning of maturity period? Maturity period is nothing but after 1 year period of time, that particular person need to repay that 1000 rupees for the bank. This is the meaning of maturity period. Now, see, now what is considered as a performing asset or a standard asset? Performing asset or standard asset is something, see, if this person who took the loan of 1000 rupees, if he is paying 100 rupees, because the interest rate is 10%, 10% of the 1000 is 100 rupees, if that particular person is paying 100 rupees to the bank every month as an interest payment, then we call such particular assets as performing assets. The name itself suggesting that the asset is performing. Asset is performing means the person who took the loan is paying paying back the interest rate, and after a period of time that person is also going to repay the total principal amount. We call such kind of an assets as performing assets. Now what is the meaning of non-performing assets? Simply, if the person who took the loan is not paying the interest rate and he is also not paying the principal over a period of time, we call it as non-performing assets. But technically, those persons who don't pay the interest rate even after the 90 days, the interest and after the principal even after the 90 days period of time, we usually consider it as a non-performing asset. If the non-performing asset continues for one more year, we will call it as a standard asset, and if it continues for even after the standard asset continues even after a further year, we consider it as a lost asset. Lost asset will come into forefront or will get surfaced once the banks will do audit. Once the concerned banks does the audit, then we will come to know that that particular person haven't paid the interest at all, and he also didn't pay the principal amount. Then it will come to forefront that that particular asset is lost completely. When asset is lost completely, then we need to go for the insolvency process, and we have the asset reconstruction companies and each and everything. I hope you know already about it, right? Next, this is the meaning of, so you understood the meaning of non-performing asset, you understood the meaning of a standard asset. First is the standard asset, next non-performing asset, next we have the substandard asset, and we also discussed about the lost asset, right? I hope it is very clear, the concepts are very clear. Next we have the repo rate and bank rate. These are the terms which are mostly mentioned in the economic survey. So that's the reason why we should have a conceptual clarity with respect to all these terms before we go and look at the data, right? Next, what is the meaning of a repo rate and what is the meaning of a bank rate? See, these both repo rate and bank rate are the rate at which the RBI is going to extend the loans for the banks. See, but there is a clear difference. Repo and bank. Repo rate and bank rate. These two rates are the rate at which the banks is going to get loans from the loans from the RBI. Say for example, rate. This is the RBI and this is the bank. If the bank want to get a loan from the RBI, it charges a repo rate. Now, if the same bank want to get a loan from the RBI, it is also going to change the bank rate. Now, what are the situations in which the RBI charges the bank rate and what are the situations in which the RBI charges the repo rate? Simply, see, RBI charges repo rate from the banks to extend the loan only for short-term period. Only for short-term period. Right? And that too in lieu or in mortgage of the government securities, I would say. See, the RBI is going to take the government securities from the commercial banks and then they are going to provide short-term loans, and the interest rate or the rate at which these short-term loans provided to the banks by the RBI in lieu of the government securities is called the repo rate. Unlike repo rate, the bank rate is something different. Here, we don't find the mortgaging of government securities by the commercial banks with the RBI. Now, it is the first important difference, and second, unlike repo rate, which is a rate collected by the RBI for short-term loans to the banks, the bank rate is collected by the RBI for the long-term loans taken by the banks. So, the basic difference between these two important is both are the rates at which the RBI extends loans to the banks. Now, our repo rate is a rate collected by the RBI for the short-term loans, that too in lieu of mortgage of government securities, but the bank rate is a similar rate collected by the RBI but without mortgaging any government securities but for the long-term period. This is the main important thing you need to remember. This is the basic difference between repo rate and reverse repo rate. See, and the rest of the terms, repo rate and reverse repo rate and bank rate, all these are discussed very much in our economic classes of Rathod's IAS. So, if you still face any kinds of problems in the conceptual clarity, just go to the website and you can clearly see the demo videos of the economy, so that after a period of time, if you listen to the classes, you will have the conceptual clarity in such a way, right? Next, let us try to understand the next important keywords that we find in the economic survey. Next, we have the scheduled commercial banks, right guys? What is the meaning of a commercial bank first, and then we are going to discuss about what is the meaning of a scheduled commercial bank. Now what is a commercial bank? Now try to understand. If a bank, see, what is the bank is going to do? If a bank, see, for example, he is another person and these are the persons, these are the depositors. Now all these persons have deposited an amount of 100 rupees in this particular bank, and we call them as savings banks deposits. Now this bank have extended a loan for this entrepreneur. The same 100 rupees is extended as a loan for this entrepreneur. You know that the deposits are nothing but the liabilities for the banks, and the loans given by them are called as assets for the bank. Through assets, they earn the profits, because asset is something which earns you some profit. So loans are nothing but assets for the banks. We have discussed it very clearly in this class itself. Now imagine on this 100 rupees, the bank is providing a savings bank interest rate of just 1%. Now on the other hand, thus on the same loan of 100 rupees that is extended by the bank to this entrepreneur, the bank is collecting about 10% interest rate. Simple. After 1 year, imagine after 1 year, the bank is going to collect 110 rupees from this entrepreneur, and the bank is going to provide 101 rupees for these people. Now the balance 9 rupees is the profit for the banks. This is how commercial banks works. Now I hope you understood what is the meaning of commercial bank. Commercial banks are both the private banks as well as public sector banks. Next, what is a scheduled commercial bank? But try to understand. We have an RBI Act of 1934. We have an RBI Act of 1934 through which the RBI, Reserve Bank of India, is constituted. Now see, there is a schedule in this act. You know, you might have heard in your polity classes that often acts have schedules and lists. So in such a way, the RBI Act of 1935 have a schedule 2, or we also often call it loosely as list 2. Now all those banks which are mentioned in the list 2 or schedule 2 of RBI Act of 1934 are simply called as scheduled commercial banks. So the things is very clear. I hope it is very clear. Now what is the important criteria that is considered by the RBI in order to make a particular bank to get listed in the schedule 2 of RBI Act of 1934 is very much important for you. Now what are the two important criteria? The two important criteria in order to make a bank get eligibility to get listed in the schedule 2 of RBI Act of 1934 is, see, the first one, those banks with deposits not less than, where those banks deposits or assets not less than 5 lakh, not less than 5 lakh. The second important criteria is those banks whose actions does not affect the interest of the consumers. Those banks actions which does not affect the interest of the consumers is the second important criteria need to be considered by the RBI in order to list any particular bank in the list 2. Right? Now what is the example of the actions affect the interest of the consumers? Say for example, imagine this is a bank. Now this bank have accepted 100 rupees of money as a short-term deposit. Now it have given that 100 rupees amount as a loan for a project for long term. Now imagine this is the person and these are the depositors. Now imagine these depositors, we is demanding that particular money after 1 year, but this is a long term project. In order to complete that particular project, imagine if we need to take 4 years of time. The person who took that particular loan for the completion of the project can repay that amount of 100 rupees only after 4 years, right? Till then he can't repay it. Once he completes the project, then only he can able to repay it. But these people are demanding that money within 1 year. So accepting the short-term deposits and lending the long-term loans is some of the adverse actions taken up by the government. Now in this situation, when the people demands, as the banks don't have the money, they will go bankrupt. They will get default. Now the people don't get the money. Of course, the people's money have the insurance of DI, CGC, Deposit Insurance Credit Guarantee Corporation of India. This Deposit Insurance Credit Guarantee Corporation of India is going to provide an insurance for your amounts in your savings banks and current banks for up to 5 lakh rupees. For up to 5 lakh rupees. And this have discussed by us very clearly in our economic classes. Right? Next. Next, we have the two important terms called revenue receipts and expenditure. Revenue receipts and revenue expenditure. And next, we are also going to discuss about the capital receipts and capital expenditure. Guys, see, whenever we talk about the budget is usually divided into revenue budget and capital budget. See, we don't actually have this word being mentioned in the Constitution of India, but in place of the budget, we have a term called annual financial statement. Of course, you would have a good idea with respect to annual financial statement. This annual financial statement, see, annual financial statement is all about the estimates of revenue and expenditure of the government for the upcoming financial year. Thus, the revenue and expenditure of the government for the upcoming financial year is called annual financial statement. Right? You also might have a good idea that every budget is going to provide us with the three important sets of data. See, for example, we are placing a budget for the year 2022 and 2023. Now, with this budget, we are going to have the advance estimates of revenue and expenditure of the upcoming financial year. See, revenues estimated. See, these are the estimates that the government is going to get this much revenue and government is going to make this much expenditure in the upcoming financial year. Everybody knows, I hope you know that the financial year is from April 1st to March 31st. Now, what is the revenue that government is going to get from April 1st, 2022 to March 31st, 2023, and what is the estimated expenditure that government is going to make from April 1st, 2022 to March 31st, 2023. This is the first important set of data that budget gives you, right? What is the next important set of data? Next, the budget is going to give you the revised estimates of the current year. See, we all know we are currently in the month of February, right? Now, you also know that the financial year ends by March 31st. Till March 31st, we are in the financial year of 2021 and 2022 only, right? So, unless and until we complete March 31st, we can't have a clear and real picture of what is the revenue and what is the expenditure of the government for that year. So, as a result of it, we have the revised estimates of revenue as well as expenditure for the current year. See, we are currently in the month of February. If March 31st completes, we will get the actual data. With respect to revenue and expenditure, what is spent and what is received. But still we are in the month of February. So that's the reason, as the financial year is not completed yet, it completes by March 31st only, we are in the month of February. So that's the reason the budget is going to give you the revised estimates with respect to revenue as well as expenditure of the government, right, of the current financial year. And you also know, but by this time the financial year, see, the revised estimates of 2021 and 2022, and by this time we already know that 2020 and 2021 financial year is completed. When some year is financial year is completed, the government is going to have accurate data. So the budget is going to provide us the actual figures of revenue and expenditure of the government of India for the previous year. So the previous year for the current year budget 2022 and 2023 is not 2021 and 2022, but it is 2020 and 2021. I hope it is very clear, because the revised estimates of the current year is produced. So these are the three important set of data that you actually find in your budget statement, right? Now, till now we are talking about the revenue, the estimated revenue and estimated expenditure. See, Everybody knows that revenue is something that is earned by the government. Expenditure is something which is spent, right? So generally, imagine these are the lists of the revenue that the government get, and imagine this is the list of the expenditure that the government makes in a particular financial year. Now, on the nature of the revenue that the government get and the nature of the expenditure that the government make, the revenue, expenditure and revenue receipts, that we are dividing the revenues into revenue as well as capital, and we are dividing the expenditure into revenue as well as capital. Now, I will give you a simple and basic thumb rule in order to identify what is a revenue transaction as well as a capital transaction. All the one-way transactions are the revenue transactions, and all the two-way transactions are called capital transactions. This is the basic thumb rule. Recently in the mains also there is a question from this topic. They just asked what are the components of revenue budget and capital budget. These are the components of the revenue budget and capital budget. Simply see, all the one-way transactions are revenue transactions, all the two-way transactions are capital transactions. This is the basic thumb rule you need to remember. Now, what are these one-way transactions and two-way transactions? Say for example, in case of, now we are going to have examples of both the revenue expenditure as well as revenue receipts. See, if the government pays salaries, to the people. Now, once the government pays that particular salary for this particular person, the government did not expect in return directly something paid by this particular person. If the salary is paid by the government to this person, the transaction ended there. Such kind of transactions are called revenue transactions. Say for example, take another example. Imagine this person is paying an income tax of 100 rupees. If the particular person pays the income tax of 100 rupees for the government, that particular person don't expect anything in return from the government directly. The transaction ends there. We call such kind of transactions as one-way transactions. Transaction means a transaction should involve the money. The government paying the salaries for the employees, the transaction involves the money, we call one-way transaction. Next, if the government gets the income tax from a person, that transaction involves the money paying the income tax, we call such kind of transactions as one-way transactions, right? Next, similarly, understand, all these one-way transactions are divided into two: the revenue receipts and revenue expenditure. Take the example of income tax. Income tax is the tax which is received by the government. It is a revenue for the government. Now, what kind of a revenue it is? So, what kind of an income it is? These are called as revenue receipts. These receipts are called revenue receipts. See, income tax is a receipt taken by the government, and what kind of a transaction is it? It's a revenue transaction. So, we call them as a revenue receipts. Now, if the government pays salary for the people, salary for its employees, now it's an expenditure for the government. It's a single way, it's a one-way transaction. So that's kind of an expenditures are called a revenue expenditure. That kind of an expenditure is called revenue expenditure. Right? I hope it is very clear. One-way expenditure, one-way receipts. Next we have the capital receipts. And capital expenditure. The two-way transactions are called the capital receipts and capital transactions. Say for example, imagine the government of India received a loan. Now, from this particular institution, when the government of India received a loan, the transaction involved the money. So one transaction is completed. Now the government is going to pay a periodic interest on the loan taken by it. Even the transaction, the interest payment transaction, is the second transaction, two-way transaction, where it also involves money. So in such a way, if the transaction is two-way, we call such kind of transactions as two-way transactions, and we call such kind of receipts received by the government. If government extends the loan for any state government, right, the central government is going to get the revenue in the form of interest payment paid by the state governments. We call such kind of transactions as two-way transactions, and we call such kind of receipts as capital receipts. And if the government makes an expenditure, say for example, if a government makes an expenditure to construct any particular factory, any particular unit, and out of this factory the government is earning an income. Now these are called as capital expenditures. If something is created, some asset is created and it's earning the profits, we call such kind of a transactions are capital transactions. So I hope it is very clear for you, and we have discussed further these concepts further in depth in the exclusive classes in our economy, right? Next we have an important term called fiscal deficits. See guys, imagine every year government makes an expenditure. Recently you have seen about the budget. Say for example, if the government wants to make a budget, lays a budget of 100 rupees, right? Imagine it is 100 rupees. Now try to also imagine that the government may get a receipts of only 97 rupees. So first of all, what is the meaning of a deficit? Deficit means we want something but we don't have it. Deficit means we want something but we don't have it. In case of in case of economy, what is the meaning of deficit? Deficit means, the literal meaning of the deficit is we want something but we don't have it. In economy, we want money, but we want some money but we don't have it. This is the meaning of deficit in the economic context, right? Now the budget laid down by the government is 100 rupees. Now it only gets 97 rupees. Now the deficit is 3 rupees. We want some money but we don't have it. So the deficit is 3 rupees. So the deficit is 3 rupees. Now try to understand that if the government goes for borrowings, and borrows the money in any particular financial year, right, we usually term it as fiscal deficit. In our economic classes, we have discussed that. We have discussed even the formula of the fiscal deficit. Fiscal deficit is nothing but expenditure minus receipts. Expenditure minus receipts excluding borrowings. Imagine the expenditure is 100 rupees as taken in our example, and the receipt is 100 rupees. In this receipt, the borrowed amount is 3 rupees. If we exclude it, we will get 97 rupees. So 100 minus 97 is equal to 3 rupees. This is called the fiscal deficit. To put it very simply, and in order to remember it very simply, what is the fiscal deficit is the amount that particular country borrows in a financial year to have the 100% expenditure, budget expenditure, is called fiscal deficit. To put it simply, the amount that the government borrows in a particular financial year is called fiscal deficit. And in our economic classes, we have also discussed about the primary deficit, the budget deficit, we have discussed about the revenue deficit, and different kinds of deficits are discussed by us very clearly in our economic classes. Just try to check it out, right? Next. The next important term is government borrowing. Now we have discussed about the internal borrowing, and we also discussed about the external borrowing. Government goes for borrowing in two ways. We have internal borrowings and external borrowings, right? We understood that 70 to 80% of the government borrowings happens internally, right? Now what are the tools available for the government borrowing? The government securities, we also call them as G-Secs, and we also have the treasury bills, right? Now let us try to understand how these terms and how this works. Imagine he's a person and he needs an amount of 1000 rupees. Now he have the two options. This person A is ready to give that 1000 rupees to him, and this person B is also ready to give that 1000 rupees to him. Now if this person goes to person A, what he says is, I will give you the 1000 rupees. Of course you want 1000 rupees and I will give you the 1000 rupees, and you need to pay me an interest of 10% on it per annum, and after 1 year you need to repay it. So we have the concepts of principal, we have the interest payment, and we have the maturity date. Now we have the second option. He can go to the person B. What this person going to do is, see, what this person B is going to tell him is, okay, you need 1000 rupees. But instead of 1000 rupees, I will give you only 900. But after, you need not to pay me any interest rate, zero interest. And after a period of time, after a period of 1 year, just pay me 1000 rupees back. Now, this is the classic examples of the way in which the government bonds works. This is the way in which the government bond works, and this is the way in which the treasury bill works. Remember, the treasury bills are issued by the government for the short-term purposes, for the short-term loans, like for 892 days, 184 days and 365 days. And the government bonds and government securities are issued by the government as a part of internal borrowings to have their long-term borrowings. So this is a mainly important thing you need to remember with respect to government borrowings, right? Next we have the FDI and FPI, right? See guys, in the capital market we have discussed about the primary market. And in the capital market we also discussed about the secondary market. Now, what constitutes the primary market? Like initial public offering, follow-on public offering. What constitutes the secondary market? Mostly the stock exchanges like BSE and NSE. To remember it very simply, guys, remember the basic difference between foreign direct investment and foreign portfolio investment in a very simple way. Simple, right? If the investment from the foreign countries comes through the primary market, we call it as foreign direct investment. And if the foreign investment comes through the secondary market, that is through Bombay stock exchanges or national stock exchanges, we usually call it as foreign portfolio investment. Remember, if the foreign investment comes through the primary markets, we call it as direct investment. And if the foreign income or foreign investment comes through the country, through the secondary market, that is through Bombay stock exchanges or stock exchanges, national stock exchanges, we usually call it as a portfolio investment. And we also discussed in our classes that the portfolio investment usually is of three types. If the foreign investment comes through the secondary market by any institution like mutual funds and any banks from the foreign countries, we usually call it as foreign institutional investment. What I am saying is portfolio investment is of three types. This is foreign institutional investment. We also discussed about the depository receipts, and we also discussed about the offshore funds. Right? This is the basic difference between foreign direct investment and foreign portfolio investment. If you don't remember the things, just try to brush up. And those guys who don't have this kind of conceptual clarity, guys, remember, you should have this kind of a basic conceptual clarity in order to understand the economic survey, right? So do have it. Next, we have the initial public offering, follow-on public offering, and offer for sale. Now, let us try to understand these important terms with a basic example. Imagine this is a company, and this company has 1,000 shares, and each share is worth of, one share price is worth of 1 rupee. So now try to understand, if this company wants to sell the shares for the first time, imagine if the company sold 200 shares for the public for the first time. The name itself is suggesting it's a public offering, initial public offering. Now, if the company sells its shares, if company issues the shares for the first time for the public, we call it as initial public offering. Right. Now, after a period of time, the promoters of this company wants to expand this company. Now, then they issued a new shares of 300, and we call it as follow-on public offering. Now try to understand, if the 200 shares is sold from that company, the remaining shares is 800, and if new shares of 300 is issued by that particular company as a part of follow-on public offering, 300 more shares is added. Totally it have 1100 shares now. Right? Now, what is the number of shares with the promoters? That is 800. Now, you know that the SEBI in 2012 came up with a minimum reserve, minimum stock with the public at 25%. In order to cope up with these kind of minimum reserves, the promoter stake was sold for the public. The top 200 companies according to market capitalization need to abide with these provisions. So we also discussed the meaning of market capitalization. What is the meaning of market capitalization? It's simple. If the company issues a shares of 100, imagine a particular company have a shares being issued in the market 100, and the price of each share is 10. Now the market capitalization of that particular company is 1000. It is as simple as that. This is the meaning of market capitalization. According to market capitalization, top 200 companies needs to maintain it. Now out of these 800 shares, if 300 shares are sold to the public, we call it as offer for sale. Try to understand. In the initial public offering, if they sell the 200 shares, 200 rupees will be deposited into the account of the company. In the offer for sale, when they issued a new shares of 300, the 300 rupees will be deposited into the account of the company. Now here it is not the shares of the company, but it is the shares of the promoters that is being sold to the public. So as a result, if the 300 shares is sold, the 300 rupees is deposited into the accounts of the promoters. Simply, if the company issues the shares for the first time, initial public offering, amount goes to the company. If the company again issues a new shares, not old, new shares, again for the public, we call it as follow-on public offering. If the promoter's shares are sold to the public, we call it as offer for sale. In offer for sale, the amount goes into the pockets of the promoters, but not into the company. This is the basic difference between initial public offering, follow-on public offering, and offer for sale. You need to remember. Next, we have the minimum support system, minimum support price. Guys, you all know that MSP is nothing but minimum support price. It is announced by the government of India. You need to remember three important words. Announced by the government of India, right? It is approved by the Cabinet Committee on Economic Affairs. It is recommended by the Commission for Agricultural Cost and Prices. Now, the Commission for Agricultural Cost and Prices will recommend an MSP, and the MSP will be approved by the Cabinet Committee on Economic Affairs, and the government of India is going to announce it before every sowing season, right? Every sowing season. Now currently for 23 major crops, the government of India is announcing the MSP. Guys, as a part of our economy lectures in part 2, we have discussed about agricultural price policy. When we discussed about the agricultural price policy, I said you that this Commission for Agricultural Cost and Prices is the nodal agency for the CACP, for the agricultural price policy in the country, and it is going to issue it is not going to recommend not only the MSP, it is going to recommend the procurement price, it is going to recommend the central issue price, and it is also going to recommend the fair and remunerative price for the farmers. So, if you don't have a clarity with respect to all these terms, these are very much important for your UPSC prelims. So, we have cleared these terms very broadly and very clearly for you. So, just go and check out the websites and try to have these classes and have the conceptual clarity, right? Next, we have the foreign exchange reserves, and when we discussed about the RBI chapter, where we have discussed that the monetary functions. We have discussed about the monetary functions of the RBI. Now, it is the responsibility of the RBI in the country, and the RBI is considered the custodian of foreign exchange reserves, right? The foreign exchange reserves does not mean always it is maintained as US dollars. Here you need to remember two important things. Whenever we talk about the foreign exchange reserves, usually they are maintained by the RBI. Whenever I say the foreign exchange reserves are maintained by the RBI, it does not mean RBI is going to maintain a stock of foreign reserves in the Mumbai office. Right, they will maintain these foreign reserves as deposits with the other countries' central banks, like the way in which you save your amount with your Indian rupees in savings bank deposits with the public sector banks. Similarly, RBI is going to maintain the foreign currency with the foreign central banks, for which they earns some revenue. We have discussed all this as a part of open market operations, right? In the part of open market operations, in the surplus transfer of RBI reserves for the government, we have discussed these concepts very clearly. So, this is about the foreign exchange reserves. Next, we have the last term, the gross fixed capital formation. Simple, guys. See, we have the meaning of working capital. We know the meaning of working capital, and we also know the meaning of fixed capital. Fixed capital is nothing but it's a fixed capital, like buildings, like the equipment, like the tools, etc. Now, we all know that the savings, we as a people deposits our amount in the savings bank accounts. These savings are utilized by the banks to provide loans to the entrepreneurs. These entrepreneurs is going to set up the units which they are going to provide employment as well as going to produce the goods. The employees receives the salary and demands the goods produced in the factories. If more and more goods are demanded by the people, so these goods will be produced. You all know the final monetary value of the goods and services is nothing but the economic national income and the GDP of the country. And if more and more goods are produced and and people demands more and more goods with the employment, the national income of the country is going to get increased. So in such a way, each and everything is interlinked. So as a result of it, the fixed capital formation is investing more and more amount of money in such kind of assets. See, this is called as capital formation. Remember guys, we have the capital goods. Capital goods are those kind of goods which are used to produce the further goods. Say for example, we have a lathe machine. It is a capital good which is used to produce different kinds of goods. Say for example, we have the tin molder. It's a machinery, it's a capital good which is going to use to produce the tins in a manufacturing company. We call such kind of goods are capital goods. Such kind of a capital goods industries is very much essential. Remember, with the presence of capital good industries in an economy, we can say the level of industrial development in the economy. So as a result of it, we need a good gross fixed capital formation in the economy. So these are the major terms guys, these are the major terms, right, which you need to remember with respect to the in economic survey, right? See, many of these terms have actually discussed by us in our classes in part 1 as well as part 2. So having a good knowledge and understanding with respect to macroeconomic concepts is very much essential. Remember two important things. Always follow the trend. These days UPSC is following a trend and they are asking the questions like the way in which they once used to ask. How they asked once? They tested the conceptual clarity of the aspirants. Now as a result of it, not only the facts of economy but also the application orientation and knowledge of the economy is also very much important. So you should have a conceptual clarity with respect to like the way in which we have discussed the inflation, like the way in which we have discussed the GDP. In such a way, you should have a conceptual clarity with respect to each and every topic in the UPSC syllabus. We have clearly discussed all these things as a part of our economic classes in part 1 as well as part 2. Right? Those students who still face difficulty in understanding the concepts, please do check our websites where the courses are provided to you at an affordable prices to have a conceptual clarity and try to improve your score in your UPSC upcoming prelims. So we will meet in the next video where we are going to interlink all these macroeconomic concepts with the actual data that we have provided, right, in the economic survey of 2021 and 2022. So we'll meet in the next class in the second part of the economic survey. There we are going to interlink them, right? I hope you understood and got some clarity with respect to these concepts, right? Thank you and stay tuned to Rathod's IAS. Hi friends, my name is Sarvan Kumar. I'm your economy faculty. Welcome to Rathod's IAS. Friends, in the previous class, as a part 1 of economic survey, we have discussed about the various macroeconomic concepts which are very much essential to understand the different data that is provided in the survey document. As you all know that economic survey will be placed in the parliament by the finance minister just one day before the budget, right? Now the economic department of the Ministry of Finance will prepare this economic survey, right, with the help of a chief economic advisor. Now to the public it is showcased by the chief economic advisor, and many of the important provisions of this economic survey will be read by him. As you can see in this picture, this economic survey is shown or given to the public in such a way. Now what used to be the earliest practices in the earlier days, in the earlier years, we used to have 2 volumes of economic survey, but unlike the regular practice, this year we just have a 1 volume of economic survey. So you have to note that in 2022 there is only 1 volume of the survey. Previously we have 2 volumes, and the first volume gives the deal with conceptual and analytical issues. It deals with the conceptual and analytical issues, and the second volume deals with the state of economy and sectors of the economy in some details with more focus on intermediate issues and statistics. You know that according to the nature of economic activity, we have 3 important sectors, that is primary sector, secondary sector and tertiary sector. So on the basis of nature of economic activity, we are classifying these economic activities into 3 sectors. So the sector's performance as well as the statistics is the main document. That volume 2 document is going to give us all these details, right? Next, as we already discussed in a long lecture with respect to all the macroeconomic concepts, just in this session we are going to look at the data which is provided by the economic survey, because after all economic survey is all about the performance of Indian economy for the past 12 months. How the Indian economy have performed for the last 12 months is the data given by the economic survey. But as a UPSC aspirant, it is very important for you. The economic survey document is important for the UPSC aspirant in all his 3 stages of preparation, like prelims, mains, as well as your personality test also. So never neglect this data. Right? Trend analysis with respect to the data is very much important. It is not only to have a good knowledge with respect to these macroeconomic concepts, but you should also have an analysis. Say for example, in the previous class we have talked about the foreign exchange reserves. Now this document is going to give you the amount of the number of foreign exchange reserves as such. Now it is also going to give you which country is the highest country with more number of foreign reserves and what countries are ahead of India in maintaining these kind of reserves. This kind of a data is usually provided by the economic survey for the students. So as a result of it, we should be very careful enough to analyze this document. So when we look at this image, see here we have the GDP growth at constant prices. Right? GDP growth at constant prices. In the previous class, we have discussed what is the meaning of GDP and what is the meaning of growth, and we also discussed the meaning of constant prices. Just if we multiply the prices of goods and services of the base year with the number of goods and services produced in the particular year, we will have the constant prices. Right? We have discussed it very clearly in the previous part 1 of economic survey. So it is estimated that it is projected that India's GDP growth rate at constant prices is going to be around 8.8% to 8.5%. Now we have the fiscal deficit as a percentage. It is estimated that India is going to have a fiscal deficit for 2021 and 2022 around 6.8%. Right? This economic survey is all about data. Right? Now the India's fiscal deficit is about 6.8% in the year 2021 and 2022. Right? And in case of inflation, right, the CPI combined inflation is about 5.2%. In the previous class we have discussed with the example, with the constitution of the price index, with this price index, how we calculate the inflation we have clearly discussed. The percentage change of the current year's price index with respect to the previous year price index is nothing but the inflation, and we also discussed that if we calculate such kind of calculations for all the products in the wholesale market, sold in the wholesale market, and if we calculate it for the bucket of goods and services, we have the CPI combined inflation as well as we have the WPI inflation. WPI is inflation, once is also known as the headline inflation because it's used to get published in the newspapers. Right? Next, we also discussed about the foreign exchange reserves, and I said you that RBI is going to maintain its foreign exchange reserves not at the head office of the Mumbai, but it is going to maintain all these foreign reserves with the different foreign banks. We call them as foreign assets, foreign exchange reserves and foreign assets with the RBI. Right? It is about 633.6 right billion US dollars at the end of the year 2021 and 2022. Even agriculture and forestry fishing growth rate is given in the economic survey at basic prices, that is at 3.9. Right? In the previous class, we have discussed about GDP is equal to GVA at market prices. Here they are talking about growth rate of agriculture sector, growth rate of GVA at basic prices. GVA at basic prices. What is the difference between GVA at market prices and GVA at basic prices? GVA at basic prices is nothing but the producer's price. The producer's price. What is the producer's price? I said, you remember, the manufacturer have priced the shirt at 80 rupees. This 80 rupees is the GVA at basic prices. So whenever you come across the data with respect to GVA and GDP, the number shows different. Whenever you see the term GVA, it is all about GVA at basic prices mostly, and when you see the GDP, it is nothing but GVA at market prices. So here we have for GVA at basic prices we have 80 and GVA at market prices we have 85. Remember the previous example. So that's the reason why the GDP and GVA data varies from when it is published in the newspapers, right? Next, even industrial growth, the growth rate of GVA at basic prices in the percentage of in the year 2021-2022 is 11.8 percentage. Services, it is about 8.2 percentage. In such a way, the economic survey is going to give you the data. You need to compare it. See, previously it is negative growth, now it is positive growth. This is the analysis you need to do, right? Earlier it is negative growth, now it is positive growth. Earlier it is just 3.6 percentage, it is 3.9 percentage now. Earlier we have just 577, now we have 633, right? 633 US billion dollars, both in the form of foreign reserves like US dollars, euros, Japanese yen. In such a way, the Reserve Bank of India is going to maintain these foreign currencies in different countries' foreign currency assets, different currencies, right? So this is the analysis you need to do, right? Now let us look at these things one by one clearly. See, now for 2022 and 2023, the GDP growth have been projected to be at 8 percentage to 8.5 percentage, right? And in 2021 and 2022, according to the first advanced estimates, it is about 9.2 percentage. In the wake of COVID-19 pandemic, it is just negative growth of negative 7.3 percentage. Now in the previous example, we have discussed that if a manufacturing company produces a cars of 100 in the 1 month, and in the next month if it produces 110, the growth rate is 10 percentage. Similarly, it should be the growth percentage. You can relate this 8.5 percentage to this 10 percentage example, right? Clear. Next, now let us look at the state of Indian economy, right? Now all this data which is present in these images is given below. The Indian economy is estimated to grow by 9.2 percentage in real terms in 2021 and 2022, right? Subsequent to a contraction of 7.3 percentage in the year 2020 and 2021 in the wake of COVID-19 pandemic. In the previous class, you have understood what is the GDP, real GDP, what is the nominal GDP. If we multiply the number of goods produced in the particular country with the current prices, we will get the nominal income. And if we multiply the number of goods produced in the country with the base year's prices, we will get the real income. This is the basic difference between the nominal income and real income. So we have clearly discussed about these things in the previous class. So try to have this data analysis. That's it. Now, GDP is projected at 8 to 8.5 percentage in real terms, right? Not in constant terms, in real terms in the year 2022 and 2023. Now, when we look at the international financial institutions projections with respect to the Indian economy, like the projection comparable, the particular projection comparable which is given by the Economic Office, the World Bank and the Asian Development Bank's latest forecast of real GDP growth is about 8.7 percentage and 7.5 percentage respectively for the year 2022 and 2023, right? Which is comparable, right? Next. As per the IMF latest World Economic Outlook projections, India's real GDP is projected at 9 percentage, right, in 2021 and 2022 and 2023, and at the end by 7.1 percentage in the year 2023 and 24, right? So according to this data of projection of IMF, International Monetary Fund, right, the India is which would make India the fastest growing economy in world for all 3 years. This is the projection. You have to remember one important thing. As per IMF's latest World Economic Outlook, these are the things very much important for your prelims. Who releases this report? World Economic Outlook report is often given by the IMF. So such kind of things are very much important for you. Just try to remember it. So World Economic Outlook by IMF. Just try to note it down in your books for revision. Agriculture and allied sectors, right? We have clearly discussed in our economic classes about agriculture and allied sectors. Agriculture and allied sectors expected to grow by 3.9 percentage, right? And industry by 11.8 percentage and services by 8.2 percentage in 2021 and 2022. I hope you clearly understood what is the meaning of growth. 100 110, the growth rate is 10%. Similar in case of these agricultural led sectors, industries as well as services sectors. I hope it is very clear. Now on the demand side, the consumption estimated to grow by 7%. The gross fixed capital formation is also by 15%. In the previous class, we have discussed about what is this gross fixed capital formation is all about, right? Now, see, the macroeconomic stability indicators suggest that Indian economy is well placed to take challenges of the 2022 and 2023. As you know, that is economic survey is all about the performance and some indicators of the future with respect to the Indian economy. Next, when we look at the fiscal deficit, I said you, to put it in a layman language, if we exclude the borrowings, right, if we exclude the borrowings of the current financial year out of the total receipts received by the government of India, we get the fiscal deficit, right? And in 2021 and 2022, according to the budget estimates, it is about 6.8%. In 2020 and 2021, it is about 9.2% of GDP. See, GDP is 100 rupees. The fiscal deficit is around 6.8, which means it is the amount that we have borrowed in that particular financial year, right, as a percentage of it. Currently, the India's GDP is about 2.3 trillion, about 197 lakh crores. Now, about 6.8% of it. So, what would be the 6.8%? Just calculate, and that's the number that we have the fiscal deficit in the country right now. Next, let us try to see the fiscal developments, economy bouncing back with the India's agile response policy. Now, revenue receipts gone up by 67.2%. In the previous class, I said you that the revenue receipts are a kind of one-way transactions, and they have increased by 67.2%. And gross tax revenue registered a growth rate over 50%. Right? Next, the fiscal deficit has been contained at 46.2%. It is contained, limited at 46.2%. With the recovery of the economy, government debt is expected to decline, because after the COVID-19 pandemic, economy started slowly to get recovered, because you know that always a consumption-led economy is going to definitely recover over a period of time. What is the meaning of consumption-led economy? Guys, you know that if we multiply the number of goods into prices in an economy, we usually get the GDP. Indians, there are about 135 crore Indians, and out of this, at least 80 crore Indians are demanding different kinds of goods and services. If goods and services are demanded by the people by doing some different kinds of a work, they are produced in the market, they are produced in the factories. When more and more goods are produced, definitely, you know the definition, number of goods into prices, definitely it is going to increase the GDP. In such a way, we have the consumption-led economy in the country, right? Now, with the recovery of the economy, you know that consumption-led economies recover, right? That particular government debts in the future is going to get declined. Now, state government's capex gone up by 67%. You know the meaning of capital expenditure. Capex stands for capital expenditure. I said you all the two-way transactions where two-way transactions are called capital expenditure. Say for example, if we decode this statement, state government's capex gone up by 67%. Imagine this is a state government, and the state government have created an asset. Now imagine I have invested an amount of 1000 rupees on creating this asset. This asset is periodically giving some 100 rupees profit to the government. So in these two transactions, two-way transactions, in the two transactions we have the money involved. We call such kind of a transactions are two-way transactions, and I said you two-way transactions are called capital expenditures. Capital expenditures are called two-way transactions particularly, right? Next, we have the index of industrial production growth at 17.4% during the April to November in 2021 and 2022, compared to 15.3% in the last year, right? Next, you know what is the meaning of index of industrial production, right? We have discussed clearly about IAP in the economic classes, right? It is all about, this index is all about, see, industries are also going to contribute a lot for the economy. If you look at the bar graph, this bar graph, we all know, see, when it comes to the labor force, when it comes to the contribution to the GDP. Now, in case of labor force, the primary sector has the highest share, next we have the secondary sector, and next we have the tertiary sector. In case of labor force. Now, in case of these three important sectors contribution to GDP, the highest is services sector, next we have the manufacturing sector, next, right, secondary sector, next we have, first we have the services sector, that is tertiary sector, second we have the manufacturing sector, that is secondary sector, and last we have the primary sector, that is agriculture sector. So in such a way, although the contribution for the labor force by the primary sector is very high, but its contribution to the GDP is very low, right? Now, in the second place, we have the industries. It is occupying a second place both in case of labor force as well as the contribution to the GDP. So as a result of it, so this index of industrial production tracks that, see, index of industrial production is going to track the production of industries in the country. As industries contributes a large share to the GDP, calculating index of industrial production is going to predict the GDP, predict the contribution of manufacturing to the GDP in the future, which ultimately gives the government and the economist a future map of Indian economic growth. So that's the reason why IAPs is calculated. Now, capital expenditure of the Indian Railways budgeted to increase 5 times over 2014 levels, right? The government is more and more making an expenditure, capital expenditure, particularly in the transport infrastructure. Guys, we all discussed that the infrastructure is divided into two, the economic infrastructure as well as social infrastructure. Now, the energy, transportation and communication infrastructure is called this economic infrastructure, like health, education and rest of the services, hotels, these comes under the social infrastructure, right? So, economic infrastructure is always very much important for us, right? In such a way, the government started increasing its economic, capital expenditure, particularly in the transport sector, right? Next, the revenue receipts from the central government from April to November quarter 2021 has gone up by 67.2%. See, as I said, the economic survey is all about the projections of data with respect, it is filled and laden up with the data with respect to economy, different variables. So, one important thing what you need to understand as an aspirant, UPSC aspirant, is you need to know a basic definitions and meanings of the terms mentioned in the economic survey. So, you know the meaning of tax revenue. Gross tax revenue registers a growth rate over 50% during the April to November 2021, right? Next, during the April and November 2021, the capital expenditure has grown by 13.5% with the focus on infrastructure intensive sectors, right? So, in such a way, you can clearly observe the data here, right? Next, when we look at the foreign reserves, as an UPSC aspirant, it is more important for you to have the trend analysis as well as the definitions and meanings of macroeconomic concepts. Remember this thing. Next, now as I said in the beginning, for image itself, we are having about 633.6 US dollar billion. Now the concept of forex, it is very clear for you right now. Next, the net capital flows were higher at 65.6 billion in the first half of the 2021 and 2022, right? Often you hear or see these kind of terms, H1 and H2 in the newspapers. H1 and H2 defines first half and second half of the financial year. You know the financial year, right? Next, on account of continued inflows of foreign investments, right? India's external debt rose to US 593.1 billion at the end of the September 2021 from 556.8 billion a year earlier, right? This is another important observation. Foreign exchange reserves crossed US $600 billion in the first half of 2021 and 2022, touched 633 in the December 2021. So you need to remember that we have a good amount of foreign exchange reserves in the country. As far as UPSC is concerned, you should be very clear with the RBI. And next, so RBI is the custodian of the foreign reserves. RBI is going to maintain the foreign currency not only in the US dollars, but it is also going to maintain the foreign currency in euros, yen, Chinese renminbi, but mostly the foreign currencies with India is in US dollars. You also need to remember all these foreign currencies are not going to be placed in the head office of RBI in Mumbai, but all these foreign reserves are maintained by the RBI with the foreign banks. Now, in case of the holding of the foreign currency reserves, at the end of the November 2021, India was the fourth largest forex reserves holder in the world after China, Japan and Switzerland. This observation is very much important for you for your exams. Next. Just now we have discussed about the NPAs, non-performing assets. What is the meaning of standard, performing assets, non-performing assets, standard assets, substandard assets, right? So the bank credit growth increased by 5.3%, right? April 2021 to 9.2% by December 2021. You know that the credit provided by the banks is very much important for the capital formation in the country. Right? Next, the gross NPAs of the scheduled commercial banks. You know the meaning of scheduled commercial banks, right? At 11.2% at the end of 17-18, and it decreased to 6.9% by the end of September 2021. The capital to risk weighted asset ratios of the scheduled commercial banks is 13% in the year 2013-14. It increased to 16.54% by September 2021, which shows that over and above the stipulated limit of capital to risk weighted asset ratios are maintained by the scheduled commercial banks. Currently, it is around 9.1%, which is stipulated by the RBI. In the previous Part 1, we have discussed that currently the capital to risk weighted asset ratios are being stipulated for the banks by the government itself, by the RBI itself. Actually, it is prescribed by the Basel III norms. Actually, unfortunately, due to the COVID-19 pandemic, we haven't implemented these Basel III norms, and it is going to get implemented after 2023 January 1st, right? I also said you that. Next. Credit to agriculture sector registered a robust growth. You need to understand that during 1950s, the non-institutional credit to the institutional credit, when we look at the data, see, in 1950s, the non-institutional credit means credit provided by the money lenders, landlords, agricultural, commission agents, all these persons comes under the category of non-institutional credit. And in the institutional credit, we have the players such as commercial banks, regional rural banks and RRBs, etc. So when we look at the data, about 93% of the agricultural credit is being provided by the NIC, and at that time only 7% is provided by the institutional credit. Now in 1990s and now currently the trend is about 75% of the credit is provided by the institutional players, and as well as about 25% still agricultural credit is provided by non-institutional players like Arhatiya agents, commission agents and etc. Now you need to remember, out of this 75%, commercial banks is going to provide the highest agricultural credit to the farmers. Next we have the cooperative banks. Next we have the regional rural banks, cooperative banks. So you need to remember even this thing, right? Next. 89,066 crores was raised via 75 initial public offering issues. Indian markets outperformed their peers. We have outperformed them, right? So we also discussed what is the meaning of initial public offering. I thought initially that if we have a conceptual clarity with respect to all these terms, it would be very easy for us to go on to look at the data in this class, right? Next. The repo rate was maintained at 4% in 2021 and 2022. We know the meaning of repo rate. RBI undertook various measures such as G6 acquisition program, government securities acquisition program. I told you as a part of government internal borrowing how the government securities works, and special long-term repo operations to provide further liquidity. You know that the repo rate is usually the charge collected by the banks, RBI, from the banks right, in levy of mortgage securities. And I also said you that this rate is collected for the short term credit. Now the RBI even went for a special long term repo operations to enhance the liquidity for the banks. The economic shock of the pandemic have been weathered well by the commercial banking system. That's what the economic survey says, right? The gross non-performing advances ratio of scheduled commercial banks had declined from, NPAs is declined from 11.2% at the end of 2017 to 6.9% by the end of September 2021. This is one other important observation you need to remember. The capital to risk weighted asset ratio of the scheduled commercial banks, as I said, it is maintained at 6.54%, well ahead than the stipulated by RBI. So RBI stipulates it currently. When the Basel III norms implements, the Basel Committee on Banking Supervision have developed these, right? And then once it is implemented in India after 2023 January 1st, that number is going to be maintained by the scheduled banks. I hope it is very clear. Next. Exceptional year for the capital markets. 89,066 crores was raised via 75 initial public offering, as we said in the image. Now we also discussed that what is the meaning of CPI combined. CPI combined is all about CPI rural and CPI urban. We have clearly discussed what is the price index. Consumer price index is nothing but if we calculate the price index and calculate inflation for only a basket of goods and services, we get the CPI rural and CPI combined urban, and we have the combined. Currently the CPI combined is the thing which is used for inflation targeting by the RBI, and we have the WPI projections also, which is 12.5%, and this is at the CPI combined is at 5.2%. Earlier, the inflation target is 4 plus or minus 2. That is to maintain the inflation between 2 to 6% by the RBI. The twin objectives of the monetary policy, as we discussed in our economic classes, is both to maintain the price stabilization in the country as well as to ensure the growth, right? Next. Right, the average headline inflation CPI combined reduced to 5.2% from 6.6%. So it is maintained well below the threshold level, limited level. Fluid inflation reduced to 2.9%, right, against the 9.1%. Food inflation need to be reduced. So in such a way it is reducing. Next, the decline in the retail inflation was led by ease of food inflation. Right? Food inflation averaged at a low of 2.9% in 2021 and 2022 against a 9.1% corresponding period last year. Right? You have to remember these analysis. Next, we also discussed that wholesale price index inflation is all about if we calculate the price index of all the products sold in the wholesale market, and if we calculate the inflation price index of the current year minus price index of the previous year by price index of previous year into 100, we get the inflation rate. If we do it for all the products, early in the example we have done it for the rice. If we do it for all the products, and if we take an average, we do it for all the products which are sold in the wholesale market. If we take an average, we will get the wholesale price index, wholesale price based inflation, right? It rose to 12.5%. What are the reasons why inflation rose? The low base in the previous year. Now, pickup in economic activity, share increase in international price of crude oil and other imported inputs. You know, we have clearly discussed what is the link between the inflation and oil prices. And we have the high freight cost. Freight is all about the goods. The freight is all about goods. So just try to have a note of all these important reasons why such kind of inflation is happened, right? Next, divergence between CPI and WPI, right? It is also peaked. Just you need to have an analysis with respect to it. And next we have sustainable and development and climate change. India's overall score on the Niti Aayog Sustainable Development Goal Index and the dashboard improved to 66 in 2021 from 60. You need to remember that Niti Aayog has an initiative, Sustainable Development Goal Index. Who publishes the Sustainable Development Goal Index? Niti Aayog. And it has a dashboard. When we discussed about the initiatives of the Niti Aayog, we have clearly discussed about it, right? Next. India has the 10th largest forest area in the world. You need to remember this trend. In 2020, India ranked 3rd globally in increasing the forest area during the 2010 and 2020. In 2020, the forests covered 24% of the India's total geographical area, accounting for 2% of the world's total forest area. These points, these are the very much important points you always need to remember. They won't ask the data directly, but they would ask the trend, whether it is increased or decreased. So you have to remember it. Next. Now we have the plastic waste management amendment rules, which aimed at phasing out the single-use plastic by 2022. What is the meaning of single-use plastic? The plastic once used and later disposed of. Like for example, your disposable glasses, the straws you use it to drink the coconut water. All these comes under the plastic waste, single-use plastic. So we have these new plastic waste management rules. Next. Extended producer responsible for this plastic packaging was also notified. Earlier, for the e-waste management, we have this extended producer responsibilities. Now, the compliance status of the global grossly polluting industries located in the Ganga mainstream and tribunals improved from 39 in 2017 to 81 in 2020. So it's also another important observation you need to remember. Now this year the extended producer responsibility is also extended for the plastic waste. You need to remember it. Earlier it was for e-waste. Next, when we look at the agriculture and food management, see, with respect to the growth rate of GVI basic prices, right, in agriculture sector, it is about 3.9% in the year 2021 and 2022. Next, when we look at the food grain production, see, in 2017-18 it is just about 285 million tons, and in 2021 it is about 308 million tons. So you need to observe one trend. From the past 4 years, from 2017 to 18, the food grain production is increasing in the country. So it is not decreasing, it is not status quo, but it is increasing. UPSC asks these kind of trends in your UPSC, in your prelims exams. So this is very important. Next, the agriculture sector have experienced rapid growth in the past 2 years. Accounting, you know that agriculture sector is the only sector that achieved the growth, that registered the growth when compared to the primary sector, the secondary sector and tertiary sector during the COVID-19 pandemic. What I mean to say is, agriculture sector is the only sector that registered a growth in the COVID-19 pandemic when compared to the secondary sector and tertiary sector. So we also discussed about the minimum support price policy, which is used to promote the crop diversification. So we know that if MSP is announced more for any other crop, apart from if CACP recommends, if CACP adds, or Government of India adds one more crop for this MSP, if say for example, if government wants to increase the production, or diversify the production of one important crop, then they can announce more MSP for that. And if more MSP and yield is more for that particular crop, the farmers of course going to shift to cultivate to that particular crop. So in such a way, the MSP policy is being used to promote the crop diversification. Now you need to remember the MSP, the procurement price, the central issue price, the fair and remunerative price, all these are going to be understood by us as a part of agriculture price policy, and the nodal agency for agriculture price policy in India is Commission for Agricultural Cost and Prices, right? Net receipts from the crop production have increased by 22.6% in the latest situation assessment survey compared to SAS report of 2014. This is another important point, but you need to remember it. Next, allied sectors also achieved a growth, and government facilitated food processing industry. Food processing is very much important, main topic for you, right? Government facilitates food processing through various measures of infrastructure development, subsidized transportation, support for formalization in micro food enterprises. We all know that if a raw material is changed in its physical form, and if it is made comfortable, more digestible and more nutritious for the consumption of human beings, we call it as a food processing. And when we looked at the food processing sector in our economy, we discussed that lack of infrastructure facilities in the food processing industries is one important thing that is hampering the development of that particular sector. Now, this survey is saying that the government is focusing on the infrastructure development for this public sector, for this food processing industries. India runs one of the largest food management programs in the world, right? We have the PDS system. The government has further extended the coverage of food security network through the schemes like Pradhana Mantri Garib Kalyan Yojana. You all know that, right? Under the targeted public distribution system currently which is implemented in the country, the government of India is providing the rice, wheat and coarse cereals at prices 3, 2 and 1. We call these food grains as subsidized food grains. It is being provided under TPDS system and it is mandated in India, right, under the Food Security Act of 2013. We all know that under Public Union of Civil Liberties with Union of India case, in this case, Supreme Court upheld that the right to food comes under right to life under Article 21. In order to ensure this legal right for the people, the government using the existing TPDS system and thereby ensuring a food security to the people, right? So, under this Pradhan Mantri Garib Kalyan Yojana, these PDS rices and wheats and all these are provided at a large scale to a certain extent in the COVID-19 situations, right? You need to remember about this scheme. Next. When we look at the industrial growth, it also achieved, it is estimated, advanced estimates, 11.8% when compared to the 2021 year, a negative growth of 7%, right, due to COVID-19 pandemic. Next. So we have seen that index of industrial production growth at 7.4% during the April quarter when compared to 15%. So the index of industrial production grew at 17.4% during the April-November quarter when compared to 15%. So what does it mean? The industrial sector is also achieving the required growth rate. Next, the capital expenditure for the Indian Railways, as we seen in the diagram, it is also being increased. So government more and more expenditure, government increasing its expenditure in it. Extent of road construction per day is increased substantially to 36 kilometers per day from 28 kilometers. So you know that infrastructure is the backbone of Indian economy, right? Whatever the prime moving force is, whether the prime moving force is primary sector, secondary sector and tertiary sector, it doesn't matter, but the basic prerequisite is infrastructure for the development of any industry or any sector. So as a result of it, government is focusing on developing infrastructure. You know that by 2024 and 2025, we are trying to become a 5 trillion economy. According to estimations and experts says that we need to invest 100 lakh crores in the upcoming 5 years in order to achieve this $5 trillion economy, which amounts to about 1.3 trillion, 1.3 to 1.4 trillion. Now, with this data itself, you can imagine the importance of infrastructure for the development of any particular sector in the country. Why the Bangalore have leading? Why the Karnataka is leading in the IT sector? Because they have developed the robust infrastructure, IT infrastructure. So you can understand it by that. See, next, introduction of production linked incentive scheme, PLI scheme, major boost provided to infrastructure, both physical as well as digital, along with the measures to reduce transaction costs and improve ease of doing business. We know that ease of doing business drawings are being provided by the World Bank, right? In India, the same work is done by Ministry of Commerce and Industry and DPIIT, right? Now, unfortunately, the World Bank, with some data corruptions being happened recently, World Bank decided that these kind of indexes need to be get revamped. So the latest, according to the latest data, we have 63rd rank, which is released in 2020 in the ease of doing business index, and it is being improving. You know that the world investors all around the world will look at the ease of doing business ranks of any country to invest their money in that particular country. Now, it is very important to have a good rank in these kind of indexes. The ease of doing business index is all about the different kinds of feasibilities and with ease that how a foreign investment can be used to run a business in the country, right? It covers the entire life cycle. So it constitutes the construction permissions, electricity connections, right? Insolvencies, all these are the parameters of ease of doing business. So that's why having a good rank in these kind of parameters is very much crucial for us, and fortunately we are at a good position in it, right? Next, when we look at the service sector growth also, it is about 8.2% when compared to the negative growth of minus 8.4%. Next, right, when we look at the gross value added, the GVA of the services crossed pre-pandemic level, right? And the GVA, see, overall service sector GVA is expected to grow by 8.2% in 2021 and 2022. See, when it comes to the foreign direct investment, during the first half of the 2021, the service sector received over 16.7 billion foreign direct investments, accounting for 54% of the total FDI flows into India. You need to remember here. So these are the areas where you need to be very careful with. So which sector attracts a largest foreign direct investment in India? That is the services sector. And in the service sector, which subsector attracts more and more foreign investments? That is IT sector. Which state attracts more and more foreign direct investment? Particularly Gujarat. From which country we have more and more foreign direct investments? From the Mauritius kind of countries. So this is the trend analysis you need to take from this kind of economic surveys, right? I hope you understood it. Next, right? India has become the third largest startup ecosystem in the world after US and China. A number of new recognized startups has increased to over 14,000 in 2021 and 2022 from 773. You know that startups are a kind of businesses, right, mainly meant for innovative products. You know that like India, for the ever growing India, we need startups and innovative products. Now 44 Indian startups have achieved a unicorn status in 2021, taking the overall tally of unicorns to 83, most of which are in the services sector. And now in our economic classes, we have clearly discussed what is this unicorn status. So that's the reason why if we have the conceptual clarity with respect to all these terms, it would be very easy to analyze the data for us, right? I hope you understood it. Next, when it comes to the social infrastructure and employment, I said you the infrastructure is of two types: economic infrastructure and social infrastructure. Energy, transportation and communication comes under the economic infrastructure. Now when it comes to the social infrastructure, expenditure on the social services by the center and state increased from 6.2% of the GDP in 14-15 to 8.6% of the GDP in 2021 and 2025. Both investments in social infrastructure as well as economic infrastructure is very much crucial, right? Next, when we look at the data of employment given by the survey, with the revival of the economy, employment indicators bounced back to pre-pandemic levels during the last quarter. As per the quarterly periodic labor force survey data of March 2021, employment in the urban sectors affected by the pandemic. You know that all the employment sectors, both organized and unorganized people, are affected due to this COVID-19 pandemic. So unfortunately, we don't have the National Sample Survey Office data being given in this kind of economic surveys. Actually, though those kind of a data will give the clear picture of the rate of unemployment and employment in the country. So you need to remember who is unemployed and who is not employed and who is not in labor force, right? We have three category of persons over here. Now, if we look at the first person, now, if a person is engaged in any economic activity, we say that particular person is employed. Now, we have, the second category of person is not engaged in any economic activity, but if somebody provides him the employment, we call them as unemployed. And we have the third category of person. This person is not engaged in any economic activity, even though if somebody provides him, he is not willing to do or not willing to engage in economic activity. We call such kind of a person as not in labor force. Not in labor force. So only employed and unemployed people, that too between the age group of 15 to 59 years, are considered to be under the labor force. You need to remember it. Only those people, both employed and unemployed, and that too between the age group of 15 to 59, are considered under the labor force, right? So in our economic classes, we also discussed about usual principal status, current weekly status and current daily status of employments. We have discussed that if a person works for at least 30 days in the reference period of 365 days, we say that his usual principal status is employed. Now, if a person works for at least 4 hours a day, we say his current daily status is employed. If a person works for at least 1 hour a day, we say his current daily status is employed for half day, right? And if the person works for if a person is not working for at least 1 hour a week, but he is ready to do that work for at least 1 hour, then we say his current weekly status is unemployed. So in such a way, we have the usual principal status, current weekly status and current daily status. These are the basic macroeconomic concepts. Please try to brush them up. right? Because these days the UPSC trend, see, let us try to understand the trend of the UPSC, the way they asking the questions, like the way once they asked, right? Next we have the National Family Health Survey. So here, according to the UPSC, you need to remember the indicators that it actually calculates: the total fertility rate, the infant mortality rate, the meaning of undernourishment and malnourishment, right? If there is low level of nutritional intake, we say that particular person is undernourished. If the nutritional intake is indiscriminate, we call them as malnourished. So expenditure on the social survey by the center and state as a proportion of the GDP has increased from 6.2% in 2014 to 8.6%. It's a good trend, right? So this National Family Health Survey report of 5 is very much important, and its indicators are also very much important. Often UPSC asks which of the following is not an indicator of the family health survey. Even these indicators shows a good sign. See, it came down, total fertility rate came down to 2 in 2019-20 from 22.2 in 2015-16. Somebody consider it as a good. We also should consider about the replacement ratio here, right? Replacement ratio is also very much important. Next, under the Jal Renewal Mission, 83 districts have become Har Ghar Jal districts. So these things, these missions which are mentioned in the economic survey is very much important for us. Increased allotment of funds for the Mahatma Gandhi Manjinarega to provide buffer for unorganized labor in the rural areas. Guys, you know how do we calculate the poverties, right? Imagine a person needs some basic goods and services in his life. Now they are like food, shelter, health, etc. If we go to the market and find out the prices of these goods is 100 rupees. Now we say if the person can make a consumption expenditure of 100 rupees, then we say that particular person is not living in poverty. If the person can't make a consumption expenditure of 100 rupees, we say that particular person is living in poverty. Why not we are considering the income, and why we are considering the consumption expenditure? Say for example, if we have a family of 4 members, a father, wife and 2 children. Now this father may be earning an income of 400 rupees. Now this father is earning an income of 400 rupees, but in order to procure the basic goods and services, he needs just 100 rupees, right? Now can we say this father is living out of poverty and these 3 people are living below poverty line? No. Why? Because even this wife have good food, good shelter, good clothing. These children are going to the educational institutions, schools. They are enjoying all the basic goods and services required in their human life without earning a single penny, right? So now clearly observe, they are sharing the amount which is earned by the father. They are not earning any income, but they are making the expenditure. Consumption expenditure means the expenditure made by the people in order to consume the goods and services. So as a result, in spite of taking the income, we are considering the expenditure because of the dependents like children, wife and age-old people, right? So the main important program in order to increase the consumption expenditure of the people, the main important program initiated in the India is this Manrega. So very much important, which provides 100 days of employment for the people, guaranteed. Next, with the revival of the economy, employment indicators bounced back during the pre-pandemic level. As per the quarterly periodic labor force data up to March 2021, employment in the urban sector affected, as we seen. Next, centers support to the states during 2021. When we look at this, right, enhanced limit of borrowing for the states. We know that Fiscal Responsibility and Budget Management Act is going to deal with the level of fiscal deficits and revenue deficits need to be maintained by the governments, both the center as well as states. It is about 60% cumulatively, 40% for the center as well as 20% for the state, which is recommended by the FRBM review committee, right? Now, we all know that the state government cannot go directly for the external borrowings. With the central government permission, it can have the external loans, that too in the form of infrastructure projects, which is allowed recently by the central government. You need to keep it in your mind in case of with respect to the UPSC. Loan to the state in lieu of GST compensation shortfall and scheme for special assistance to the state for capital expenditure is also done, right? See, when we look at the data, 70% of the population is aged 18 plus. fully vaccinated. 93% vaccinated with the first dose, and total vaccination administered during is about 157.94 crores. You know that, don't confuse that if the total vaccines administered is 157.94 crores, we have that much amount of people. We have two dosages. The first dose 91.39 crores, the second dose for the 66.5 crores, and the rest of the 30 crores people need to get the second dose. So this is the meaning of it. Next. So when we look at the economic survey, see guys, so these are the important set of data that the economic surveys provides to us. So so the basic macro concepts that is mentioned in the survey, the basic macro concepts mentioned in the survey, that we have discussed very clearly as a part of first video, and the rest of the schemes and initiatives. Guys, economic survey mostly provides you with the data with respect to the performance. From the data, how UPSC asks the questions, trend analysis. Just now we have discussed about the agricultural production pattern, whether they have increased from the past 4 years and 5 years or it is decreased. These kind of questions are asked in UPSC if you observe the previous year questions. And even the budgets provides you with respect to the changes in the taxes, in the tax systems, and the budget also going to provide you the new schemes and initiatives. So the new schemes and initiatives, the tax reforms if at all provided, and all those macroeconomic words and concepts mentioned in the surveys and budgets are the main things you need to study and take care of while looking at the budget and survey. I hope by now everybody have completed their preparation with respect to the Indian economy, and for those who don't or who lack in conceptual clarity and have some gaps in their knowledge, this part 1 video is the previous part 1 video is going to help you a lot. So be aware with the each and every data. You need to remember the data, but you need to remember the trends. That's it. As UPSC going to ask you, it's not going to ask you the data mentioned in the survey. It is going to just ask you about the trends, and it is going to ask you about the macroeconomic concepts which we have discussed in the part 1. Right? I hope you have understood and enjoyed this economic survey part 1 as well as part 2. And in the next classes also, we are going to continue with the economic current affairs, right? So whenever we discuss about the current affairs, we are going to do one thing. First, we are going to have a good conceptual clarity with respect to macroeconomic concepts, and then I am going to give you the current data. This is how you can amalgamate both the concept as well as current affair combinedly, so that there will be a good conceptual clarity for you, right? This is how the economy should be read, right? I hope you understood and enjoyed this session. If at all you have any doubts in the conceptual clarity, just try to rewind the part 1 once again and look at the part 2 video and analyze the data and keep it in your mind. If at all something is need to be noted, I have a separate page for 1 to 2 pages and note it down, and have the conceptual clarity of part 1 and have the data analysis for the part 2, trend analysis for the part 2. That's it. Mostly your economic survey preparation will be completed, right? I hope you enjoyed this video and stay tuned to Rathod's IAS. Thank you.